Look around you. Prices soaring, headlines screaming, everyone saying, this time it's different. But let me ask you a dangerous question. What if it's not different at all? What if what you're watching right now is not growth, but pressure building? What if the silence before the storm has already begun? People believe real estate only goes up. They believe because prices have gone up. But history doesn't reward belief. It rewards preparation. This market wasn't fueled by fundamentals. It was fueled by cheap money, easy debt, and blind confidence. When borrowing feels painless, logic disappears. When risk feels invisible, bubbles are born. Here's the truth most people don't want to hear. Value and price are not the same thing. When prices rise faster than incomes, rents, and cash flow, something breaks. Smart investors don't chase applause. They chase numbers that make sense. They ask hard questions while others celebrate. They protect cash while others overextend. This isn't about fear, this is about clarity, because when rates rise, leverage suffocates. When payments jump, emotions change, and when emotions change, markets follow. But listen carefully. Every collapse writes two stories. One story is about regret, people who borrowed too much, believed too blindly, and ignored warnings. The other story is about opportunity. Those who waited stayed liquid and acted when others panicked. The winners aren't lucky, they're ready. They understand cycles, they respect risk. They know that downturns don't destroy wealth. Unprepared people do. If you want to survive what's coming, stop following noise. Focus on cash flow, reduce unnecessary debt, build reserves, strengthen discipline. Because when the pressure releases, and it always does, the market will transfer wealth from the emotional to the prepared. This is not the end. This is a reset. And those who stay patient, informed, and calm won't just survive the pop. They'll rise from it. Bubbles don't explode in a single moment. They stretch, they bend, and they weaken long before anyone hears the sound. At first, everything looks normal. Prices keep rising, demand feels unstoppable, and confidence grows louder. People confuse momentum with stability. They mistake rising numbers for proof that risk no longer exists. But beneath the surface, the pressure is already building. History shows that every major collapse was preceded by a period of comfort, not chaos. The danger doesn't arrive with panic, it arrives with applause. The earliest cracks are subtle. Growth begins to slow, not collapse. Small changes in borrowing costs start to matter. Affordability quietly erodes, but headlines still focus on record prices rather than shrinking buying power. Instead of asking whether something is sustainable, people ask how much higher it can go. This is where logic begins to fade. Warning signs don't feel like threats when the crowd is celebrating. They feel like background noise. One of the most ignored signals is when prices detach from fundamentals. When assets rise faster than income, rent, or productivity, something unnatural is happening. Value no longer drives the market, emotion does. Speculation replaces strategy. People buy not because the numbers work, but because they're afraid of being left behind. This fear doesn't look like panic, it looks like optimism. It wears the mask of confidence. Another crack appears when leverage becomes normal. Debt stops feeling dangerous and starts feeling necessary. Borrowing isn't questioned, it's encouraged. The idea of risk is dismissed with phrases like everyone's doing it or it always recovers. When leverage spreads across the system, even small changes can have massive consequences. A slight increase in costs, a minor slowdown in demand, or a shift in sentiment can expose how fragile the structure really is. Markets don't collapse because everyone suddenly becomes irrational. They collapse because too many people make the same rational decision based on false assumptions. They assume growth will continue. They assume liquidity will remain. They assume someone else will buy at a higher price. When those assumptions are tested, cracks widen. Sellers appear quietly at first, transactions slow, confidence turns into hesitation. Most people ignore these signs because they don't fit the story they want to believe. Optimism feels good. Caution feels boring. No one gets praised for stepping aside while prices are still rising. Warnings are labeled as negativity. Prudence is mistaken for fear. By the time the cracks become visible to everyone, the opportunity to prepare has already passed. There is also a psychological trap at work. People anchor their expectations to recent success. If something has worked for years, they assume it will keep working. They underestimate how quickly conditions can change. They forget that cycles are not broken by belief. Markets don't care about confidence. They respond to math, incentives, and pressure. Cracks spread slowly because systems are designed to hide stress. Short-term solutions mask long-term problems. Adjustments are delayed, extended, or restructured. This creates the illusion of stability, but it also increases fragility. The longer the pressure builds, the more violent the release becomes. Stability without strength is not safety, it's risk in disguise. Those who understand this don't wait for headlines to turn negative. They don't need a collapse to confirm what the data already shows. They watch behavior, not predictions. They study affordability, cash flow, and leverage. They recognize that the real danger is not the pop itself, but the denial that comes before it. The biggest losses are rarely caused by sudden events. They are caused by ignoring slow, obvious signals while hoping tomorrow will look like yesterday. When cracks appear early, they offer something valuable: time. Time to adjust, reduce exposure, and prepare. But time is only useful to those willing to see what others refuse to acknowledge. Cheap money doesn't feel dangerous at first. It feels generous. It feels like opportunity. When interest rates are low and credit is easy, borrowing stops feeling like a risk and starts feeling like a shortcut. Money becomes cheaper than patience, and leverage replaces discipline. What people fail to realize is that cheap money doesn't create real value. It creates the illusion of it. Prices rise not because assets are stronger, but because access to debt is wider. When borrowing costs fall, buyers can pay more without feeling the pain immediately. Monthly payments look manageable, so logic is suspended. Instead of asking what something is truly worth, people ask how much they can borrow. This shift is subtle but dangerous. Markets stop being driven by fundamentals like income, productivity, or cash flow and start being driven by financing terms. Value is no longer measured by reality, it's measured by affordability under artificial conditions. Easy credit fuels competition in the wrong direction. Buyers don't compete on quality or long-term returns, they compete on leverage. Whoever is willing to borrow more wins. This pushes prices higher but not stronger. It creates a fragile structure where prices depend entirely on continued access to cheap debt. The moment that access tightens, the entire foundation is questioned. Cheap money also distorts behavior. It encourages speculation over strategy. People begin to believe that holding an asset alone guarantees profit. Effort, analysis, and patience feel unnecessary when prices rise automatically. This mindset spreads quickly. Risk is normalized, caution is ridiculed, and debt is celebrated. What should be treated as a tool becomes an addiction. Another illusion created by easy credit is the belief that losses are temporary and manageable. When money is cheap, refinancing feels like a solution to every problem. Strain is postponed, not resolved. This delays reality and deepens exposure. The longer this continues, the more people build decisions on the assumption that conditions will never change. But financial environments always change. Cheap money doesn't eliminate risk, it concentrates it. It pulls future demand into the present. It inflates prices today by borrowing from tomorrow. When tomorrow arrives and conditions tighten, there is nothing left to support those inflated values. What looked like growth is revealed as imbalance. The most dangerous part of easy credit is how invisible its consequences are in the beginning. Rising prices feel like success. Rising debt feels like progress. Few stop to ask whether the returns justify the risk without borrowed fuel. Few test whether the asset can stand on its own. When credit tightens, illusions collapse quickly. Payments rise, margins shrink, and confidence evaporates. Prices that depended on cheap money are forced to reconnect with reality. This adjustment feels sudden, but it isn't. It's simply the moment when the illusion can no longer be maintained. True value survives without artificial support. It holds up under pressure. Cheap money masks weakness, but it cannot strengthen fundamentals. Those who understand this don't chase inflated prices driven by easy credit. They recognize that when money is cheap, discipline is rare. And when discipline is rare, risk is everywhere. Real wealth is never built on excitement. It is built on consistency, patience, and numbers that work even when no one is watching. Hype feels powerful because it moves fast, but speed is not strength. Speculation promises quick wins and dramatic stories, yet it rarely offers stability. It depends on timing, emotion, and the belief that someone else will pay more tomorrow. Cash flow, on the other hand, does not rely on hope. It relies on reality. When decisions are driven by hype, the focus shifts away from sustainability. People stop asking whether an asset produces income and start asking how quickly it can be sold for profit. This mindset turns investing into gambling. The outcome becomes dependent on market mood rather than performance. When confidence is high, speculation feels smart. When conditions change, it becomes exposed. Cash flow is boring to those chasing excitement, but boring is powerful. It doesn't need perfect timing. It doesn't depend on rising prices. It works in good markets and bad ones. An asset that produces consistent income provides flexibility, stability, and time. It allows decisions to be made calmly instead of under pressure. This is how discipline protects wealth. Speculation magnifies emotion. It creates anxiety during downturns and arrogance during booms. People overreact because their position has no foundation. Without cash flow, every price movement feels personal. Fear forces bad decisions, and greed encourages overextension. This cycle destroys fortunes not because people are unintelligent, but because they are undisciplined. Discipline means respecting numbers even when they contradict popular opinion. It means walking away from deals that don't make sense, even when everyone else is rushing in. It means accepting slower growth in exchange for durability. Discipline is uncomfortable because it requires saying no more often than yes, but that discomfort is a form of protection. Cash flow exposes truth. It reveals whether an asset can stand on its own. It forces realism. If income doesn't cover costs, the asset is not an investment, it's a bet. Many people confuse appreciation with value, but appreciation is external. Cash flow is internal. One depends on the market, the other depends on structure. Fortunes built on hype rise quickly and fall just as fast. They look impressive from the outside, but fragile underneath. Fortunes built on cash flow grow quietly. They don't attract applause, but they survive storms. They compound because they are not forced to sell at the worst moment. Discipline also creates optionality. With stable cash flow, there is no urgency. There is no panic when markets shift. Opportunities can be evaluated objectively instead of emotionally. This is how wealth compounds over time, not through dramatic moves, but through steady positioning. Speculation tells people they are smart when prices rise. Discipline keeps people solvent when prices fall. One feeds ego, the other feeds longevity. In the end, markets always test structure. Hype fails that test. Cash flow passes it. Preparation is quiet. It doesn't announce itself with bold predictions or dramatic reactions. Panic is loud, emotional, and reactive. When markets turn, panic feels urgent, but urgency is rarely intelligent. The people who survive downturns are not the fastest to act. They are the most ready before action is required. They understand that markets reward those who prepare early, not those who react late. Panic is what happens when decisions are made under pressure. It forces selling at the worst time and buying at the most expensive moment. When people are unprepared, every market move feels like a threat. Fear replaces logic, and short-term emotion overrides long-term strategy. This is how downturns turn into disasters for those who failed to prepare. Preparation begins with understanding risk before it becomes obvious. It means knowing exactly where exposure exists and how fragile it is under stress. Calm investors don't guess, they measure. They know their numbers, their obligations, and their limits. When conditions change, they are not shocked because they have already imagined that scenario. Liquidity is one of the most underestimated forms of strength. Cash is often criticized during boom times because it feels unproductive. But during downturns, liquidity becomes freedom. It provides options when others have none. Those who are liquid don't need to sell in fear. They can wait, negotiate, and act with intention while others are forced to react. Being informed is different from being overwhelmed. Prepared individuals don't consume noise, they study signals. They understand cycles, incentives, and pressure points. They don't rely on optimism or pessimism, they rely on data. This allows them to stay calm when headlines become dramatic. Calmness is not ignorance, it is clarity. Preparation also means accepting that downturns are normal, not exceptional. Markets move in cycles, not straight lines. Those who survive don't view declines as failures of the system. They see them as tests, tests of leverage, patience, and structure. Panic fails these tests. Preparation passes them. When fear spreads, calm becomes an advantage. Most people underestimate how powerful emotional control is during financial stress. Staying calm allows better decisions, better timing, and better outcomes. It creates distance between stimulus and response. That distance is where intelligence operates. Those who prepare don't need to predict the exact moment of change. They don't rely on perfect forecasts. They build resilience instead. They position themselves so that no single event can destroy them. This mindset transforms downturns from threats into environments where opportunity can exist. In every cycle, wealth moves from those who panic to those who are prepared. Not because the prepared are braver, but because they are liquid, informed, and calm when others are emotional and forced to act. Every crisis feels unique while it is happening. Fear convinces people that this time is different, that recovery is uncertain, and that waiting is dangerous. But history shows a consistent pattern. When fear peaks, opportunity is being created. Not for everyone, only for those who prepared long before panic took over. Crises don't create opportunity by accident. They reveal it by forcing prices to disconnect from long-term reality. When fear dominates the market, logic becomes rare. Assets are sold not because they are worthless, but because people are over-leveraged, exhausted, or forced to act. This is how value emerges. Prices fall below fundamentals, not because the underlying asset has failed, but because confidence has. Those who are ready understand this distinction. They don't confuse emotion with reality. Once-in-a-generation opportunities are not obvious in the moment. They feel uncomfortable, lonely, and risky. Buying when others are fearful means acting without social validation. It requires conviction, not courage. The crowd always feels safer, but safety in markets is often an illusion. The best opportunities appear when consensus is most wrong. Fear peaks when uncertainty feels unbearable. Headlines are negative, forecasts are extreme, and past losses dominate thinking. This environment pushes most people into survival mode. They focus on preserving what remains instead of positioning for what comes next. Those who are ready think differently. They see distress as a pricing mechanism, not a permanent condition. Being ready means more than having capital. It means having emotional discipline. It means resisting the urge to wait for perfect clarity, which never arrives at the bottom. Opportunity doesn't announce itself with certainty. It appears when confidence is lowest and doubt is highest. Those who understand cycles know that waiting for comfort means missing value. Crises also reset standards. Bad deals disappear. Weak structures are exposed. What survives is leaner, stronger, and more realistic. This creates a foundation for long-term gains. Those who enter at these moments benefit not just from recovery, but from improved fundamentals. Time begins to work in their favor. Fortunes are not built by predicting crises, but by being positioned for them. Liquidity, patience, and preparation turn fear into leverage. While others are focused on loss, the prepared are focused on alignment between price and value. The greatest transfers of wealth occur quietly during periods of maximum pessimism. By the time confidence returns and optimism feels safe again, the opportunity has already passed. Those who act when fear peaks are not reckless, they are simply ready when others are not. What lies ahead will not reward optimism alone, and it will not punish caution. It will reward awareness, discipline, and preparation. Markets don't move wealth randomly. They move it from those who ignore reality to those who respect it. This moment is not about predicting exact timing or dramatic collapse. It's about understanding pressure, recognizing illusion, and positioning for truth. Those who stay informed instead of emotional, liquid instead of leveraged, and disciplined instead of speculative will not be shaken by what comes next. They will be steady while others rush, focused while others panic, and ready while others regret. The cycle will turn, as it always does, and when it does, the outcome will be decided not in the moment of crisis, but by the choices made long before it arrived.